This diagram compares the financial foundations of two globally recognized companies, starting with Alphabet, Google's parent company. If you look at their asset column, you will find a cash and short-term investment position exceeding $100 billion. They sit on a mountain of liquid wealth. Now look at McDonald's. According to traditional accounting, their total shareholder equity sits firmly below zero. Mathematically speaking, the company owes more than everything it owns combined. This creates a strange contradiction. Standard textbooks tell us McDonald's is insolvent, yet the market values it at hundreds of billions of dollars. Meanwhile, Google is frequently criticized for sitting on too much cash and running an inefficient balance sheet. While one appears bloated and the other appears bankrupt, these strategies are calibrated to very different economic realities. To see how both can be right, we have to revisit the basic definition of money itself. At the root of the financial system is the monetary base, the physical currency and bank reserves directly controlled by the Federal Reserve. This visual spectrum maps how that base money expands into the real economy. The first layer is M0 and M1. This includes physical bills and digital balances sitting in checking accounts, assets that represent immediate, highly liquid purchasing power. But banks don't just hold those deposits, they lend them out, creating a much larger credit economy known as M2. This encompasses savings accounts, retail money market funds, and small certificates of deposit. Megacorporations, however, hold too much wealth to rely on FDIC-insured bank accounts. They operate above M2 in the wholesale money market, a shadow banking layer where they use sophisticated instruments like commercial paper to park their billions. This shadow liquidity spectrum reveals the true mechanics behind how Google and McDonald's manage their wealth. Google operates in the hyper-volatile tech sector. Because artificial intelligence and hardware development require massive, unpredictable capital expenses, they avoid heavy debt. Instead, Google acts as a net lender, storing their cash buffer in short-term treasuries and wholesale commercial paper. McDonald's has a completely different reality. People eat fast food regardless of the economic climate. Through a vast network of franchisees paying rigid rent and royalties, their daily cash flow behaves like a guaranteed annuity. Because their income is so predictable, McDonald's management aggressively issues cheap, short-term debt in that shadow banking layer. They then take that borrowed money and use it to buy back their own stock at market premiums. This chart demonstrates the goal of that strategy. Debt is cheaper than equity, and interest payments are tax-deductible. By borrowing heavily and wiping out their accounting equity, McDonald's forces their overall cost of capital to its lowest possible point. And who exactly is lending McDonald's all this cheap money? The buyers of that commercial paper are often cash-rich institutions and corporations searching for safe, short-term yields. In practice, Google effectively functions as the shadow bank funding McDonald's stock buybacks. Corporate finance is an ecosystem, with tech giants providing the liquidity that legacy brands use to leverage their returns. But extreme leverage carries a distinct vulnerability. What happens to a negative equity company relying on short-term debt when the Federal Reserve's base money stops flowing and the wholesale credit markets completely freeze? This scale illustrates why corporate giants died in the 2008 financial crisis. Lehman Brothers collapsed under the weight of toxic mortgage assets. Even General Electric faced ruin because they used short-term debt to fund long-term, illiquid assets. When the funding vanished, they couldn't make payroll. McDonald's survived without a scratch. Their daily cash flow allowed them to maintain Tier 1 commercial paper status. While investors fled panicked investment banks, they rushed to buy McDonald's debt as a safe haven. The panic was so severe that Federal Reserve Chairman Ben Bernanke launched the Commercial Paper Funding Facility, allowing the Fed to step in and directly purchase Tier 1 corporate debt to keep the American payroll system functioning. 2008 proved that in a crisis, the immediate reliability of cash flow is a more effective shield than a stockpile of reserves. But the financial environment has drastically shifted. To fight inflation, the central bank has shrunk the monetary base and pushed interest rates up to levels we haven't seen in nearly 2 decades. When risk-free treasury bills yield 5%, the math behind a negative equity strategy breaks. The hurdle rate for any corporate maneuver suddenly jumps. Borrowing cash at high rates to buy back your own stock is no longer a cheap optimization. It becomes a financial penalty. This dynamic is why highly leveraged dividend stocks have struggled to keep pace with cash-rich tech companies recently. Interest rates act as the gravity of the financial world. When that gravity increases, the optimal strategy for corporate survival flips from borrowing to hoarding. This leads us to a final market paradox. When rumors circulate that the Federal Reserve might cut interest rates, why do the stocks of distressed, near-bankrupt companies skyrocket, while stable blue chips barely move? This chart plots the Merton model. It treats equity as a call option on a company's total assets, measured against its debt. Distressed stocks operate deep out of the money. Their asset value has fallen below what they owe. But the possibility of cheap liquidity saving them from bankruptcy gives that call option explosive potential. McDonald's, conversely, is a deep in-the-money option. Because their assets consistently dwarf their debt obligations, their stock behaves much more like a stable, low-volatility bond. A slight rate cut barely registers on their valuation. Money is a dynamic tool, defined by its position on a shifting spectrum. Whether hoarding it to survive the future or leveraging it to maximize the present, success requires mastering the ever-changing layers of liquidity.